We welcome you to this virtual event on Asian and European repo markets during COVID-19, which is organized jointly by ourselves, ICMA and ASIFMA. I'm very happy to be joined by Rebecca Weinrach, ASIFMA's head of fixed income, who will be co-moderating the discussion with me. We have a very distinguished panel of guests today, 2 based in Asia Pacific and 2 in Europe, all of whom have extensive experience and senior roles in the repo markets. Our panelists are Gareth Allen, Managing Director and Global Head of Treasury Assets of UBS, Andy Hill, my colleague, Senior Director and Head of Secondary Markets at ICMA, Puneet Jain Shah, Head of Asia Repo for Barclays, and Gary Shields, Head of Asia Repo for ANZ. The panel discussion today will take about 45 minutes, after which we plan 10 to 15 minutes for Q&A. If you're joining using Zoom, then you can use the Q&A button within the app at any time during this webinar to send your questions to us. If you're dialing in, then you can still send in questions. Please email them directly to events@icmagroup.org. That's events@icmagroup.org. And the questions will get to us. Please note that all participants, all delegates, will be muted during the presentation. A recording of this webinar will be made available to all who have registered, and over the next few days, we will send an email with the relevant links. Please ask us if you did not receive this and would like to send it to colleagues or other market stakeholders. So without further ado, let's get started, and I'll hand it over to Rebecca to begin. Rebecca?
Thank you, Mushtaq, and good afternoon, everyone. The first question I'd like to ask you, Puneet, is in your experience, how has the repo market in Asia developed in the last couple of years, and how do you see it adding value to the financial ecosystem?
Thanks, Rebecca. Hello, everyone. In terms of how things have evolved in last few years, there are quite a few things I would like to point out. First being, I would say, in addition to just more participants coming in and increased liquidity, one thing I would like to point out is that how the market has changed from being mostly just like a long-only kind of market versus how it is now more similar to how the markets are in Europe and US, where there are many participants who do participate both from long side and the short side. And we've also seen a big change on how the specials market has developed. A part of it has been because many portfolios continue to unlock and add into the repo market. So let's say we go back 4 or 5 years, although the private banking side was a big portion of Asian credit markets, but it was almost unheard of that they would lend out their portfolios in the repo market for yield pickup. But in last 4 to 5 years, we've seen the big private wealth managers who have worked with their end clients in, explaining how it can give them yield enhancement and working on documentation with the end clients. We've seen that a lot of those portfolios have been unlocked. So in terms of availability of specials, it has changed substantially in last 3 years, where a lot of smaller issues were just very difficult to play from the short side, but now that's not the case. And now it's much easier to take view on the long side as well as short side. Another thing which has increased, not just in Asia, but also globally, is more collateral swap transactions as compared to just outright financing transactions. So what we see now is, and this works well for the ones who are lending cash in terms of balance sheet utilization, is that instead of lending cash, we see the cash lenders or the ones who have appetite to take risk to the other side are more willing to do this in collateral swap. So if someone is long US Treasuries or Sing Govies or Aussie Govies, instead of deploying cash, they would deploy those high quality assets and take the other side. It could be credit bonds, it could be local currency bonds, and then earn a fee. And this is a more balance sheet, like good for balance sheet from their perspective, which is why we see this picking up globally as well as in Asia. And just number of participants continue to increase, whether it's US banks, European banks, or regional banks in Asia. We do see every year, we've seen like, to anywhere 3 to 5 new participants coming in last few years. So there has been change around the volatility. Whenever the volatile periods come, we do also see that, yes, some do pull back, some stay back, but overall, there has definitely been an increased trend of more broker dealers, more clients, and also more inter-dealer brokers who are operating in this market.
Thank you. And Gary, you also run your repo desk here in Asia. Do you have anything you want to add on to that?
Hi, Rebecca. Hi, everybody. I'd endorse what Puneet just said there. I think we're a little bit later to the party than Barclays, but we saw, I suppose, when the regulatory environment changed after the GFC, capital adequacy, and just in terms of moving away from interbank, just unsecured to secured, we've seen a lot of regional banks take a lot more notice of the collateral that they have and to optimize that. So when you go calling to get a GMRA in place, people are looking at CSAs and obviously now recently initial margins and so forth. So getting traction with legal departments and other institutions to put documentation in place has got far easier. And we've gone now to the next level where quite a few counterparties are talking about tri-party transactions, securities lending, as Puneet mentioned there, HQLA, non-HQLA switches, cross-currency trades, especially with the JGBs among Japanese participants for dollars. And just in general, we've moved away from being a very bond-centric to a kind of a balance sheet management tool. And obviously, Hong Kong is the center of all this. It's where the core of all dollar funding is done in Asia, and where there's a fair degree of clientele there. But we've seen now, slowly but surely, local market developments where we're seeing a lot more activity in the Philippines, Indonesia, places like Thailand as well. And the term of the repo is obviously lengthening all the time, notwithstanding what's happened with COVID. We were seeing basically a very short-term market, very small lots trading to larger size tickets and moving out the curve towards 2, 3 year, even 5 year. So it's, as Puneet said, we're getting a bit more developed, and it's happened in a very short space of time.
Okay, thank you very much, Gary. Well, let's go right into this recent months and the COVID crisis. And perhaps I'll start with you, Andy. You just authored a report on the European markets during the COVID crisis. Could you share with us some of the lessons that were learned and some of the main themes that you've seen about market performance and dynamics during the crisis from where you sit?
Yeah, absolutely. Thanks, Mushtaq. I think one of the, I guess, the headline observation that comes through in the report is that at least from the perspective of the European market, it held up pretty well. The market functioned, but there were clearly some very tight spots, particularly around or leading up to March 18th, when we had the central bank intervention, the ECB intervention with the announcement of the PEP. And one of the interesting points that comes out of our analysis, we looked at obviously how trading volumes, and volumes increased significantly. And I'm sure Gareth can say more on this in a moment. But as we saw a flight to quality, as investment funds took money out of risk assets, put them into the very short end, and also with increased volatility, as we saw a rush for collateral transformation to produce VM, there was a significant increase in trading volumes. At the same time, the capacity of the banks to intermediate that increase in volume was not commensurate. We took a snapshot. People are probably familiar with our semi-annual repo surveys, but we took a snapshot at the end of March to ascertain banks' balance sheets for repo. And we see that on average, there was an increase in capacity, or at least in positions, of about 8%. But if you look at the median increase, it's actually a decrease, it's -4%. So what we see is, first of all, an increase in capacity that is not commensurate with the actual volumes that we're trading at that time, and also a concentration to a few large banks. The combined effect essentially restricted access for a lot of market participants. And if you are an asset manager with a particularly heavy balance sheet footprint, pension funds would be a great example, where their activity is very much one directional, where they're generating cash from their holdings to post VM. That can be challenging, and that was certainly the case that we've heard from talking to our buy-side community, that leading up to March 18th, it was becoming extremely challenged, and the timing of the ECB intervention was certainly helpful.
Thanks, Andy. Do you mind if I just drill down a little bit when you mentioned the increases in volumes? Could you give us a little bit more detail about what segments of the market, what participants were especially active, and what were the drivers of that increase in volume, and then how that related to volatility in the market as well? And perhaps Gareth can add as well.
Yeah, absolutely. I mean, Gareth was there in the front line, so he's probably better positioned to answer that. But the drivers essentially seem to be, I mean, we had a huge sell-off in risk assets, as you know. So safe haven parking of money, but also the increase in volatility. If you look at the VIX around that time, volatility was at record levels, I think, surpassing even that of the 2008 financial crisis. So the demand to use a repo market to generate variation margin was pretty significant. And if you look at trading volumes from the interbank market, obviously we don't have data from the B2C market, but if you look at the interbank volumes at that time, particularly for bunds, which is essentially the closest thing we have to a safe asset in Europe, the increase in volumes was pretty significant. But
yeah, I guess I'd Hey, I would echo there, right? I think we saw in March it was a perfect storm of things, right? We had the market volatility, huge swings that we've not seen for near on over a decade, I guess, in the equity markets, and then this huge risk off with very large directional moves in kind of what we maybe class as risky assets, plus all, I guess, the uncertainty and fear. And I think you've got to think that and then plays into the whole of the collateral and securities markets and derivatives markets. Huge market risk positions being margined in the derivatives world. Suddenly a massive spike in demand for variation margin. So people are calling on all their liquidity reserves, and pockets of collateral, across the globe to try and meet those margin calls. So we saw like a huge spike in volume. And I guess some of the infrastructure in the market, it's still not, we're still not joined up. The ability to move a piece of collateral around the globe from Asia all the way through to the US time zone, is pretty difficult at the best of times. So when you see these these large spikes, I think business as usual, everything kind of looks fine. But I think big change. Banks have started to really optimize their capital usage, their balance sheet usage, liquidity usage, down to the penny, so they don't have the reserves or the capacity to just step into the market and intermediate liquidity provision between customers the way that they used to, which I guess is evident in what you saw. And then I guess the need then for the central bank intervention, huge central bank interventions.
Yes, actually, could you say a bit more about that? Of course, we hear about the central bank interventions. Generally speaking, and I think Andy certainly opined on this, it's been very effective, and we've heard from the traders that it was generally rightly timed and very beneficial to the market. But could you say a bit more about the intervention, and the different parts of the intervention from different aspects of the world, and how that actually affected the repo markets? What were the dynamics going on during that time?
I think I would say there are two pieces of it, right? One is around direct liquidity provision in your domestic market. So every central bank was looking to flood the market with liquidity. You know, we talk about QE over the last few years, and you know, you can see the kind of the rate of purchase in the US and across Europe. March was kind of, you know, this blew everything else out of the water that had been done in previous years, and I think kind of probably led by the Fed, in which they came out very strong and decided, you know, we're going to do absolutely anything to, you know, to get a lid or get a grasp on the crisis. Mm-hmm. So there was direct liquidity provision. So every central bank stepping in to provide liquidity against, you know, central bank repo eligible assets. But I think the second part of the story is the dollar story. Right. You know, so, you know, the dollars is still, you know, pretty much the reserve currency of the world. And when the panic first set in, you saw huge moves in the cross-currency basis markets. You know, so as everyone ran to US dollars as a safe haven, you know, the ability to transform any other currency into dollars, you know, became, you know, near on impossible. So that week of you know, that Andy mentioned, leading up to the 19th of March, you know, there were certain days where it was pretty nigh on impossible to swap at when you get to a certain volume and depth in a currency, to swap into US dollars. So that's when you saw the central banks come in with the very successful coordinated swap lines. You know, so they came in very decisive, quickly followed by a number of other central banks where they joined as well, where we had flat pricing structure for 3-month access to US dollars against all of the local eligibles. So it was essentially a big cross-currency repo. So any market participant Right. with access to central banks could access a huge cross-currency repo in unlimited size for US dollars, and you saw that in the uptake. It was hundreds of billions across the different central banks within the course of a couple of weeks in uptake, which calmed the markets tremendously, and some of the basis markets then collapsed back down to more normal levels.
And how did it play itself out in terms of the different sectors and different types of collateral?
I was going to say that one clear thing that we saw, and which increased even further with the Fed and ECB actions when they just came in, was the differentiation of various types of collateral. So if you look at like IG had a floor in the sense that Fed or ECB will take that paper and you would be able to fund it. And high yield in that sense was really getting very, very far away from where it was getting funded pre-crisis. And at some point, the bids were just disappearing. And that got reflected in the underlying markets as well, where the spread on IG bonds versus high yield bonds was getting quite far away. So that came out very, very clearly in the repo market. So now things have started trickling down, and given that markets are stable, we are seeing the high yield bid coming back in last 2 months, I would say. Critical for the end clients, the ones who operate more in the high yield markets. I think it was very, very critical for them, and how they navigated through it, and how the banks did work with the end clients to somehow provide them stable funding. And it was just not about what the funding is, whether it's 10 basis points, 50 basis points here and there, and it was just more about whether you can actually fund a particular asset or not. So that was a very clear divergence we saw, and I think given that recent happening in the market, in general, the market would be a little more cautious around taking risk, and we would probably see not that kind of divergence, but I would think that the compression that we saw most of last year would probably not go back to the same levels, and we would still see people differentiating a little bit more than what we saw pre-crisis.
Well, this is very interesting, Praneet, and if I may jump ahead a bit, I'm actually curious when you say the markets have somewhat normalized now. We've seen some compression, but not the compression that not the levels that we would have seen from last year. Do you think the market has fundamentally shifted, even if it's, so to speak, goes back to normal? I mean, has the repo market, especially in Asia, fundamentally changed after the crisis? And I'd be curious to hear the other panelists' view as well on this.
I think there are two things. So one is fundamentals where, yes, we see the divergence and we know that, yes, these things don't make sense to trade around the same level and we should differentiate things. But the other side is also technical, which is the amount of liquidity which is being pumped into the system, whether it comes from central banks and also because of lack of leverage. If you look at the numbers in terms of how much cash is held by, global RMs or even hedge fund side, it's a bit on the higher side even now. So the cash is still waiting to get deployed. So what we've seen is that in short term, liquidity is very, very flush, and there is people don't really think it's going to change in the short term and happy to deploy liquidity irrespective of credit quality. But where you see more difference is more in the longer term markets. So if you have to fund something for 1 year, for example, then the difference between where you could fund a high quality bond versus a low quality bond. So that I think to some extent stays, but still have to see if the central banks are coming in and saying that they would do everything and they would not want to upset market, or we just have to see where things balance out between the technicals and the fundamentals.
Okay, thank you.
I would echo some of the comments there in that we've obviously saw, I don't know, if we go back the last 3-4 years, maybe 5, huge spread compression and huge haircut compression in all of the asset classes. So every market globally has been converging, and I think there's a big difference between the pricing of the risk and this liquidity story. So the fact that the globe has been flooded with liquidity from central banks, that keeps those spreads very narrow, but that's not necessarily a true reflection of the risk in some of the markets. And obviously when you then see March happen, you see a huge gapping. It's massive gapping. So we saw like immediate spread reversal, and then suddenly the spread differential was back again. So high yield markets, almost off the chart, right? So the Fed came in to cut rates, and the repo rates didn't move. In fact, in some cases, repo rates were going up in certain asset classes. Obviously balanced then with the haircut, people looking at haircuts and the margin they were taking on their SFT books, and pretty much thinking, well, these haircuts do not cover the price moves we've seen in the last 2 hours. It was almost like an intraday. We're calling margin here for trades which might be delivered tomorrow, but we're thinking, okay, well, the price move in the last few hours, it's it was kind of well, very, very rarely seen. So that's why you obviously then saw the haircut moves as well. And I think on the point, will it go back to normal? Spreads have streamed straight back in. The initial stress has gone, and so very quickly I think you revert to this the liquidity view. So there's a lot of liquidity out there, so everyone has hoarded that liquidity, and well, we need to do something with it now. Looking at your economics or your cost of carry, your negative cost of carry of holding tens of billions of spare liquidity, and well, it has to go somewhere, right? So yeah, so I think things will normalize quite quickly. I do hope though on the haircut side, things are a bit more reasonable, and people are quite prudent in terms of their approach, when we think about the haircutting our risk.
Thanks, Gareth. And Gary, could you tell us a little bit about your experience as well, particularly during the crisis and dealing with some of these credit issues haircut volatility, and so on?
Yeah, sure. I mean, just exactly what Garrett said. We went from an operational risk issue in the first couple of days, then we moved to liquidity once we got that pump coming in from the Fed. Then you also had a situation where regulators were probably easing off on, in terms of regulatory reporting and giving people a bit of latitude to keep on lending to the real economy. And that would have had an effect on the credit market because certainly out here, people were trading the bonds. Bonds are going special, but the normal source of those bonds to do covers wasn't available. People felt they couldn't settle, and people were chasing them, and then they became very, very expensive. So obviously the fail rate went up dramatically at that time. But taking all those things into perspective, and then when the liquidity began to settle, and we now looks like we're going to have those programs in place at the end of the year. The programs that are being used the most are the repo swap line that Garrett spoke about there, and obviously the facility that the Fed started last September after we had that SOFR spike. And that was a bit of a precursor to what we've experienced. So we've seen this, the Fed being there all the time. It's the lender of last resort. It's now the buyer of last resort. And we see, especially in the shadow banking part of the world, money is now flowing into the public kind of mutual funds and to the private hedge funds. So we're now in a situation where spreads have come in, liquidity is ample. The last couple of days, I don't think many people have even used the Fed. Now we're going into probably a phase, especially in Asia, where there's a few forecasts regarding perhaps downgrades, defaults, and so forth. In Asia, I think there's been 14 so far, and now I think it's an insolvency question. It's more than probably a liquidity question. And as the guys spoke about there, we've got compression in spreads back to where they were prior crisis. That kind of liquidity and credit premium is not really priced in the repo market at the moment, I think. So we may see a bit of disturbance coming from maybe announcements by companies in the next while. I mean, another thing that could be a concern is that a lot of people working from home or business contingency in banks are pretty well developed, but in other companies, corporates in Asia, there could be a situation where the disclosures might be a question for some market regulators right now to make sure the information that's coming to market is correct. So I think we could be into a different phase now because things have, as they normalized, and haircuts are something that the regulators wanted in place for a long time, trying to encourage both on the sovereign and on the some sovereign anyway, and on the credit bonds. And I think it's something now that every credit policy is going to have to look at again, seeing are they adequate and are they fit for purpose. So we're going to see that certainly baked in a lot more, and how that risk appetite is reflected in the price.
I think I'd agree, Gary, there in terms of you had this initial reaction affected all risk assets. So all risk assets gapped, which was a bit of a blanket approach. No one really knew. I think this second phase, which is going to be, like maybe even a multi-year phase where, lots of businesses will struggle. People will go out of business because of the crisis. So people are going to start looking at that fundamental credit and really exploring, can you weather this storm? And that's when I think you would then see differentiation, both in terms of counterparty credit risk, so banks extending liquidity, applying haircuts, etc., and then also the underlying collateral. So people really looking at underlying collateral. We'd be looking at sectors that are exposed to the crisis, whether it's travel, entertainment, kind of all the sectors which we know are going to suffer, and they're not going to go straight back into business as usual. Airlines, transport, oil. There's a kind of an oil story going on at the same time, in the past few months as well. So I think you'll see much more scrutiny against certain sectors and counterparties, which is a healthy thing.
Okay, thanks, Gareth. Now, we've been skirting around, I think, and touching upon the issue of operations and how the markets have actually functioned. And I want to drill down a bit into that. And particularly, Gary, sitting in Asia, just in terms of settling repo transactions, this involves infrastructures located around the world. And to what extent were these tested during the COVID crisis, or at least during the worst of it? And how did your desk respond to this? How did the market manage some of these difficulties just in getting trades done with the volumes that we had?
Yeah, I mean, that was the first concern. I mean, in previous crises, we've had, obviously, the risk would have been liquidity 10 years ago, 12 years ago. Operationally, this was interesting because you're having a shock everybody at the same time in every location. I suppose Asia had a little bit of an advantage in the sense that we're used to having typhoons going through Manila, and that means sometimes we have to move in our instance, we would move some of those transaction management into our other hub in Bangalore. But what you also have is, because of political unrest in Hong Kong, we saw in 2019, a lot of people had moved to stay at home and other contingencies, and that would include banks, asset managers, and so forth. So I think when it came into kind of mid-February, before the Fed began to cut rates, I think everybody was beginning to already look at what could happen and test systems. So I found actually it was surprisingly well how both ourselves, interdealers in both Hong Kong and back in Australia, and also we have here in Singapore, managed to keep talking to each other. Even then, some of the larger regional banks, again, no problem. And again, the non-banking financial institution sector did surprisingly well. What I did notice was, in the early days, there was some accounts mightn't have been able to trade or a bit nervous about settlement, because this is a dollar center, so you'll have a situation where APAC companies are settling through perhaps outsourcing to their operations in either the Middle East or in India, and then you have the custodian will be Euroclear or Clearstream. So, and then on further, if you're doing US Treasuries, back into the US. So it was quite an interesting kind of development, where people were working from home on laptops and making sure that you had the connectivity in terms of your systems, seeing risk systems from a front office point of view, the comms between the back office, mid office, front office, they were all tested. Obviously, from a compliance point of view, you had your cyber security, making sure everything was able to function, and then having the right connections with your clearer. So what I think helped during all that time, both in terms of daylight limits with your clearer, and also I think there was a good practical understanding demonstrated by the regulators. I think they are aware people are under immense pressure, and in order to keep the system going, they had to give some leeway, and I think that worked quite well, both in Hong Kong and Singapore, to the best of my knowledge. You know, also in Australia, I think also the RBA and APRA were very instrumental in keeping things moving along there. So and obviously the Austraclear and so forth. So I think this was a real surprise for something as big as this affecting so many people at the same time. I think that the disturbance was relatively moderate to low.
Okay, thank you. Just one follow-up question, just out of my own curiosity. You mentioned the regulatory response, which seems to have been very pragmatic and helpful. What specifically did they do in terms of the repo markets, in terms of, if I may say, forbearance, or allowing the markets to function well, or providing support? I'm just curious what was the role of regulators in keeping the markets running smoothly, from your personal experience? Well,
by and large, with my Australia hat on, there's a zero tolerance for fails in Australia in the repo market. So I think knowing that some of the customers were trading from Euroclear across settlement bridges, they were giving a little bit of latitude if bonds were not settling on time. Similarly, I think just in terms of reg reporting, I mean, I suppose the resilience of the banking system is quite good, that banks are well capitalized. So I think just within a day, in terms of reporting, let's say, risk positions and so forth, there was a little bit more latitude given. Now, it's not the same across the board, it's not written down, but I think they were having sufficient discussions with balance sheet managers across Asia, and giving them that chance to keep their doors open and to function.
Okay, thank you. And Puneet, tell us about your experience. Was it similar in terms of the operations in Asia?
Sure. Yeah, I would think it was quite similar across quite a few banks who did have operations offshore specifically, which I think quite a few of us do. And very, I would say very basic things like just having normal, stable internet connection was also an issue in many places. And when everyone had to work from home, even if everyone is working, the productivity just goes down. If it's 100%, it'll probably go down to 70, 80%. And that's something we experienced. And so that was one part, that the productivity went down. The second part was just the increase in volume with the volatility. And the third thing was, which we noticed was more on the short side. The lenders of the bonds were less willing to keep lending the bonds. So they were getting, so a lot of holders of the bonds were not sure whether they want to hold the bonds or they want to sell the portfolios or what do they want to do. So they wanted to have that flexibility more than what it was in normal times, and they wanted to recall more bonds. So the number of recalls on the special side went up very significantly as well. And we also saw the buy-ins, which is the mini closeout, which is usually the last resort, and it's very rare to really execute buy-ins or initiate buy-ins for most of the participants, because it's a long procedure. It's a bit painful to actually do it. And that went up as well. So just a mix of all those things meant that there were just too many fails to handle, and the backlog kept building up. So at least in our side, what ended up happening was that there was like more headcounts were deployed to actually look at this. Some of the function we started bringing it back and getting, instead of the outsourced ones, Barclays employees started looking at it and try to just clear up the backlog. But yes, that was a big thing which came out of here, that the whole infrastructure is set up to completely work from home or not be working as usual. Maybe we are set up to, let's say 40%, 50% doesn't work as usual, but not all of it. So one of the regulations which is expected to come next year, which is the CSDR, which talks about the mandatory buy-in if there is a fail for a certain amount of time. So that also came under more discussion whether the industry is actually ready for it. So one good thing which came out was it has been delayed to 2021 instead of 2020 at least. So it gives more time and probably more discussion around, whether it would actually make things better, or would it reduce liquidity in the market and might, if we apply a very extreme scenario like a mandatory buy-in.
Okay, thank you. Actually, that's a really interesting point you raised. I hadn't thought about that in terms of bondholders. In terms of bondholders wanting to hold on to their bonds because of the uncertainty, and in some cases recalling them. Now, I'd like to hand it over to Andy, actually, because I know CSDR is a topic very close to your heart. And also, I have to admit that in my experience, the knowledge and awareness of CSDR is relatively low. So many on this webinar might not be familiar with the workings of CSDR, or if they're vaguely familiar with the settlement regime and buy-in rules, they may wish to get a clearer explanation of it. So Andy, if you don't mind, maybe we can just back up a little bit, explain what a buy-in is, what the current practice is, how CSDR may change that or is going to change that, and what are the potential implications for the market, and what have we learned from COVID in terms of those potential implications? Sorry, it's an 8-part question, but
yeah, I'll try to answer as best and as quickly as I can. Vineet touched on a really interesting point, where you do have a settlement fail whether it's in an outright cash transaction or whether it's in a repo or a securities lending transaction, there is usually a contractual right to enforce delivery. In the case of an outright security sale, if you purchase a security and it's not delivered, you will have the contractual right, generally in bond markets under the ICMA rules, where you can source the securities elsewhere for guaranteed delivery. And then you settle the difference in price, which can obviously be either higher or lower between the parties. And it essentially restores everybody to the position they would have been in had the trade originally settled. Because buy-ins tend to be for guaranteed delivery, there is usually a premium to the market price at that time. And that is essentially a cost that's borne by the selling party, regardless of any market moves. Now, as Gary also mentioned, during the crisis, particularly in March, we saw in Europe, settlement fails increase significantly. Now, settlement efficiency in Europe, particularly for the bond market, is very good, even in a negative interest rate environment. Fails generally don't last for more than a day, and it's a very small subset of overall transactions. During March, fails for bonds increased between 2 and 3 times, and those fails were sustained. The market tolerated those fails because it was understood that this was largely being driven by operational challenges. And also, this was not a credit crisis. This was a liquidity crisis. There was no concern about counterparty risk in terms of their ability to deliver. And eventually, these fails did get cleaned up. Euroclear, I think, opened on a weekend at the end of March to deal with the backlog. By the time it got to April, the situation was almost back to normal. Now, the mandatory buy-in regime, which Puneet mentioned, which is due to come into force in February 21, essentially forces firms to buy in failing transactions, whether they want to or not, whether it makes economic sense to or not. You have to buy in your counterparty. And this applies to trades that will settle on an EU CSD. So this includes Euroclear and Clearstream. And the application of the rule is not based on the jurisdiction of the counterparties. So if you're an investor in Hong Kong or Singapore, and you purchase securities to settle on Euroclear or Clearstream, and those securities fail after a very short period of time, you will be forced to buy in your counterparty. Now, this has raised...
Sorry, Andy, just to be clear. Sorry, Andy, just to be clear, I think this is an underappreciated point, but it's an EU regulation, but it applies to all bonds traded on any clearing systems in Europe, including Euroclear, Clearstream.
Absolutely.
Which would apply to many Asian bonds.
Absolutely. Yes, there is an expectation. In fact, it's more than an expectation, it's a requirement in the regulation that any trading party, any party in the settlement chain, so this goes from the CSDs themselves right through to the custodians and eventually the trading party, they will have in place contractual arrangements to ensure that the regulation is enforced. So by February, if you're an Asian investment firm who settles trades on an EU CSD, including the ICSDs, you will find that you will be signing contracts, probably with your custodian, saying that you will buy in failing counterparties. Now, if you look at what happened in March, where and the scenario that was described by Gary and Puneet, what we saw in Europe, if you had a mandatory buy-in regime in that scenario, you're then talking about globally firms having to buy in all these fails in a market that was illiquid and in a market that was extremely volatile and gapping, in the case of bonds, gapping points at a time. And I think there is now a growing realization that even in the most benign market scenarios, having a buy-in regime could be particularly counterproductive for in terms of liquidity, especially for less liquid securities such as credit. In a volatile market, in a stress market, such as we saw in February and March, this could be pretty catastrophic and has pretty serious implications for market stability. So we are hoping that the European Commission will reconsider the application of this regulation. But as it stands, and to Puneet's point, this is expected to happen from February 1st, 21.
I would just echo some of the thoughts there, right? So I think settlement discipline is very important, right? And it's important for the functioning of our markets, and it's important that we keep a kind of a constant pressure on people to ensure settlement discipline. So parts of CSDR, like the fails charges, you know, there are other regimes in other jurisdictions like TMPG in the US around fails. This puts a pressure on people, or an economic incentive not to fail, even in negative rate environments. But yeah, I think if you look at kind of March, when the market was jammed with fails, the last thing anybody would want is to then have a kind of a regulatory necessity to go out into the market and purchase illiquid securities where there are no offers. It would you know, catastrophic, I think it would be a good word. You know, I don't think, you know, people aren't failing in that situation because, you know, they're doing it for a, you know, because they want to fail for any other reason. You know, it's because collateral's stuck in pipes, in systems, you know, operational reasons, we're working from home. There could be any number of reasons, but I think, you know, people failing on purpose, I think, is I guess where the traditional fear of negative rates comes from, because of the economic incentive there is not at the top of the list. You know, that's my perspective.
Sure, thank you, Gareth. Well, unfortunately, it seems to me, at least as far as I understand, this is a law. It is going to be implemented. It's going to be hard for the European Union to amend the law or to repeal it, as far as I can tell. So, what can the market do at this point to prepare for it? What are the potential remedies in terms of contract and operations, market practice, and is there any leeway that can be offered by ESMA, for example, at this point?
I'll just mention something very quickly on the contractual work to support implementation. At ICMA, what we're doing with respect to bond markets and also repo markets, a certain segment of repos will be in scope. On the bond markets, we're updating our rules so that they will be compliant, or at least help support compliance, so that essentially they will mirror the provisions outlined in the regulation. So at a trading party level, that will provide the contractual support. And similarly with the GMRA, we are producing a CSDR settlement discipline annex, and that work's being done in parallel with ISLA, who are producing a GINTLA annex. So at least from a trading level, contractual perspective, that will certainly assist global firms to comply.
So we have one question so far. A question to Gareth Allen. When you said the haircut pretty much cannot cover the intraday price movement, while normally margin call is calculated end of day every day, I'm wondering whether you think there's any method to reflect the intraday volatility of the underlying bond. Thank you.
Yeah, no, it's a great question actually, and I think people should really differentiate between what I feel is that there is a market haircut out there, and you know, a market competitive haircut where people are quoting for their counterparties, but then each firm, each institution should have a view on what they think maybe a risk-free or a reasonable haircut might be. However you define this, they should have a methodology. You know, and you would look at things like, you know, the type of collateral, the volatility of the collateral, and that includes, you know, the intraday swings, you know, and obviously as time series move on in various models, we've now got March as an experience, and we can feed that information into our models, right? Which tells us, okay, what could be the largest price move on a given day, during a given day, etc. You know, so it's more information to allow people to make their models more complex, more reflective of the potential gap risk that we have in the markets. And then it's up to each institution then to make a decision on transactions and the risk reward on a transaction. So, you know, if you feel that a haircut should be 25% on a security to cover, you know, the worst risk that might occur, but it's a short dated transaction, and, the market haircut is 10 or 15, then you make a risk-based decision on whether you enter the transaction or not at those levels. But I think, yeah, it's important that everyone thinks about things like this price volatility and feeds it into their own thinking to manage that risk prudently.
I would just add to that on open repo transactions, the haircut is also, we can also change the haircut. So if actually things have moved significantly, it's prudent to have that discussion, to have that mutual discussion, whether the haircut, if it was X% earlier and now, given what the volatility is, it should actually be 2X. And if both sides agree that that's the right haircut, you continue with the transaction. Otherwise, if it's an open transaction, you do have that flexibility to either close the transaction or come up with something which works for both parties.
Can I just add as well something to that as we got more international here, the counterparties in the repo business in Asia, from central banks down to hedge funds, is that the counterparty risk has to be brought into this as well, because if you're dealing with, again, the shadows or non-banking financial institutions, or on the interbank side, it's about who provides liquidity, is it two-way, how long the trade's for, and so forth. And again, it comes back to the point that the haircuts do reflect that credit risk, and also goes back into your capital costs. So you want to, if people are going to do more risky stuff, and obviously on the question of sales as well, is that it's all contained in that, to have a more kind of comprehensive policy, and that's what regulators have been looking for in the last number of years. And obviously cross-currency repo is a big thing in Asia also, and having the adequate haircuts there is important to show that you're meeting your capital hurdle as well.
Thanks, Gary. And just a reminder, we still have time for questions, so please feel free to use the Q&A function or email us directly. But as there are no further questions at the moment, I actually wanted to follow up to Gary. You just mentioned cross-currency swaps in Asia as well, and I'm curious how these have developed over time. I know Puneet mentioned that, and I think you mentioned as well, that these have grown in importance. What are they being used for? Who's involved in cross-currency swaps, and how do you see the market evolving over time? How is repo used in this?
Well, I think for a lot of banks, whereby their national market isn't that developed, we would have quite a lot of where the cash flow is going to be in dollars. We would have, let's say, that was the initial situation where Philippines would be Philippine government bonds against dollar cash, and we would have seen that in Indonesia as well. Now, you also have the interesting point here to remember is that the onshore issuance is in the domestic currency is HQLA, while the dollar-denominated piece is not. So that is another difference to how people use that market. And then I think the big one in Asia is basically the activity of Japanese banks with dollar-denominated CLOs and how they fund those. And the JGB market then crosses into the dollar market, and they use those JGB holdings for dollars. So that's a big component of dollar flow in Asia. So it tends to be more sovereign, in my experience.
If there aren't any questions from the floor, I have a question. I'd like to ask our panelists, if you were to look back on March 2020, and it were 5 years from now, what do you think the biggest event, the biggest change in the industry is going to be from the extreme stress we all experienced with COVID?
I think for me, one huge thing which we should not underestimate is the fact that most of us are sat here working from home. So in our industry, this has always been a kind of a big taboo, kind of off-premises trading, regulatory restrictions, etc. But I think, we proved that, within the short space of time, within a couple of months, the whole world went home, and we continued to operate. We put in place, enhanced supervision. We got people the right equipment, and pretty much, yes, there have been operational difficulties, but things are functioning, right? And this isn't just a single event, a single firm. This is the whole market went home front to back, all the way through our infrastructure, settlements, custodians, market players, which I think, hopefully to me that makes has a long lasting impact as to how we do business in the future in our industry.
Well, from an ASIFMA perspective, we've been hearing from regulators that work from home going forward is really at the discretion of the financial services companies themselves. As long as you can sort of meet with the regulatory requirements, they are, or at least some regulators are agnostic.
I guess one additional lesson learned that we'll probably reflect on for many years, if not decades, is how dependent not just the repo markets, but financial markets in general are on central bank intervention. I think they've gone from beyond being the lender of last resort to being almost lender of first resort. And I think it could be a very long time before the market's operating normally without being propped up by central bank interventions.
Gary, do you have any thoughts?
I'll just echo what Garrett said there, because I think a big focus for the regulator going forward will be conduct. They haven't been able now to do on-site inspection. Supervision is now going to be done virtual. They're going to have to change how they even look at banks day to day. I heard something regarding the fund management space where there's been an issue with redemption notices being recognised. So I think by and large, which kind of overlaps a little bit with our question about closeouts and looking for the bonds back and having fails. So I would say operational risk is something that the regulators around the world, IOSCO stuff, is going to come much more center stage. 20 years ago, nobody looked at liquidity. BAL 1, BAL 2 were totally forgotten. This time round, obviously, with the capital adequacy rules in place and liquidity management and just prudential supervision, things were in good space, and they managed to deal well with it this occasion. So I think conduct is the next big thing which the regulator will be looking at, and especially for the repo market, whereby you have a lot of counterparties that are supervised by regulators. Insurance companies will be also supervised, but there's quite a big group of participants in the repo market don't have the same level of regulation around them, and that's something I would say which can be attacked from a conduct perspective.
I would say the whole how the whole dynamic working evolves would be quite interesting, and as Gareth pointed out, that we have all like the banks have shown that it does work, and this was completely unheard of, especially in sales and trading kind of roles that people would be working from home, and it has happened. And I think this would probably mean both from employers and employees' perspective that there are more working options available as compared to just being your regular hours in office, and so this would be interesting to watch.
Indeed, and thank you for those very good insights. Before we close, we just have one more rather technical question, so we'll just finish that. For Andy Hill, what is the timeline for the GMRA GMSLA CSDR annex?
We are hoping we can get that done in the next 2 to 3 months. The indication from members is that for both the buy-in rules and the GMRA annex, we'll need about 4 months. So yeah, ideally we want to have that done by the end of the third quarter of this year.
I think it's also worth saying though that getting the annex done is one step. Putting that annex in place with your counterparty base before February next year is an absolutely monumental industry task. We all know how difficult it is to redocument and repaper counterparties, and that's not to be underestimated. So that is, I would say a tight timeline is an understatement.
And we haven't even started talking about IBOR transition, but that's for another event. I'm sorry, that's all the time we have. So thank you all very much for joining. If you have any questions or any comments on this panel discussion, please feel free to contact either Rebecca at ASIFMA or myself at ICMA. We're very grateful for any feedback that you have or any of the ideas for future events or webinars.